Some people call it auditing. When you talk about auditing, some people will refer to it as traditional auditing, or some people will say auditing in early days. We say auditing is a Latin word, or is borrowed or derived from a Latin word. We say it means audire. Audire is where we borrowed that particular word, which means to listen. To listen. Basically, what it means here is that previously, or in early auditing, the auditor will come to an organization, examine everything, transactions and what have you, and report to the owners of the company orally or verbally. So I'll stand, if I was an auditor in early days, and I'll maybe go ahead and tell the owners of the company what I've seen in the company or the state of affairs of the company. So auditors was derived from a Latin term, which means audire or to listen. But that is not the key point here. The key point is to look on the features of early auditing. Features of early auditing. This is another way of saying what characterized early audit. If you go to some years ago, maybe like 100 years ago, you realize that the companies that we used to have were very small in size, very small. Maybe the company will have maybe very few transactions. We'll have maybe very few employees. We'll have maybe very few activities. And for that reason, one of the features in early auditing whenever an auditor used to come was the objective was detection and prevention of errors and frauds. Of errors and frauds. This is because if you check one of the features of early auditing or early companies was that the owner of the company was also the manager of the company. And in most cases you realize that the manager will just know the affairs of the company. So there was no need of an auditor coming to the company and start talking about the affairs of the company when the owner of the company was in that company. So the main purpose of the auditor was to call an auditor to come and help us to investigate maybe a fraud that had been committed by the what? By the employees of the company. And that was the primary objective. I believe this is one of the reasons why most of the people even today believe that the auditor's work is to detect errors and frauds. But that one has so far changed because of so many activities that we are going to be discussing later, referred to as factors that have contributed maybe to the changes from early auditing to modern auditing. Because we are talking about the owner of the company being the manager of the company, then it's good to go ahead and say the appointment of an auditor, the duties of an auditor, the rights of an auditor, the powers of an auditor in early auditing, including the removal and other provisions where we can say provisions were defined by the owner, were defined by owners or management. So in early auditing, we never had anything like the owners and the managers were separated. No. In early auditing, we had the owner and the manager were the same person. And because the manager was the same person, then automatically if we wanted to appoint an auditor, the manager will do it, will define that particular term and say who is going to be an auditor. When an auditor arrives and maybe if they find that he's very qualified, they will go ahead and give him duties according to their own way of thinking what the auditor should do. Then there was rights of an auditor. If you had rights or maybe powers or freedom in that company, that was defined by the owner of the company who was also the manager of the company. And that was another characteristics of the early auditing. That appointment, duties, rights, powers, everything was defined by the owner of the company, and that was the manager of the company. For that reason, if you had to write a report, all the reports that you wrote were addressed to the owners. We can say owners, but because there was no difference between owners and what? And management, so we also put management of the company. Management of the company. Because the owner is the one who appointed you, gave you the duties, then automatically any report you write, you should direct it to the what? To the manager of the company who is the owner. For that reason, it also says, or we can also go ahead and say, that company was a small in size. It was not like the modern today multinationals and what have you. So we say, because of the size of the company, whenever an auditor wrote a report, he was writing a report on the transaction he has audited. And because the transactions were very few in number, then automatically we say, one, the auditor audited or examined all transactions in a single audit. So if we had maybe few transactions like maybe 20, 30, 50, those ones you can be able to complete them in a single audit. So because you're auditing everything, you are examining all the transaction. One of the characteristics in area auditing that we can go ahead and say is that now you can tell us about whether transactions are correct or whether they are fair or whether they are true. So if you are to write a report, the opinion will be using the word true and correct rather than true and fair, which is being used today in modern auditing. So we say the emphasis was on true and correct. Correct in this case means or will amount to what we refer to as certainty or maybe 100% accuracy. And like in today's audit, we don't use the word correct. So the emphasis was on true and fair. True and correct view. True and correct view of the company's state of affairs. That is how the opinion will be drafted. But something else that we need to know about the area auditing is that the auditor would conducted final audit as the main audit. Today, you cannot lie yourself that you're going to audit a company by coming here at the end of the year. The numerous number of transactions and the large volumes of transaction has made the auditing of today more difficult, more complex, such that you cannot do a final audit to complete that kind of an audit. And so it becomes very difficult. Because you could also be able to audit all the transactions at once, then we say the emphasis was on all areas, or we can say all areas in auditing were given equal attention. This one means, like in today's audit, whereby we say some areas are high risky, some areas are less risky, those days everything was treated the same. So if you could find maybe stock and cash and you wanted to audit them, then you could treat them equally. Today, we say cash and stock have different risk, especially on what we refer to as what? Especially on what we refer to as stock. Stock is more risky compared to cash, for that matter. So something else that made the area auditing very interesting is that most of the auditors would combine auditing with other services. Combine auditing with other services in the client's company. For example, you could come to the client and the client will tell you, today you're going to do audit. Then tomorrow you're doing what? Accounting. Today you're doing auditing. Tomorrow you're doing what? Taxation. You're doing audit. Tomorrow you're doing consultancy. So you could do so many activities in the same client. Today it can't happen like that because we say in today's audit, the auditor is independent. And if the auditor today is independent, then tomorrow, not tomorrow, but yesterday he wasn't. Or we say in area audit he wasn't. So we say auditor's independence was not a requirement. Not a requirement. So that was not there. So you could be compromised because you're doing so many services and the owner is the one who is telling you what to do. And therefore you could be compromised very easily. So because the owner is the only person who had contract with you as an auditor of the company, then we say the auditor's liability was limited to contract auditor's liability was limited to contract. This one, I mean, it goes like, unless we have a contract between me and you as an auditor, there is no other person who can sue an auditor. Today, it is different. Today, an auditor can be sued for something we call tort. That is, any third party who suffered a loss, irrespective of whether he was in the contract or not, and he can prove that the auditor was negligent, he can sue an auditor. But in those days, the auditor's liability could only arise where there was what? There was that particular thing we refer to as contract. That becomes the features of area auditing. We have so many things we can look at the area auditing, but I believe that no one can give you an idea of maybe what area auditing was all about. As you can see, the primary objective was what? Prevention and detection of errors and frauds. The appointment of an auditor was done by the management. The report was addressed to the management. The auditor examined all the transactions in a single audit. The emphasis was to prove true and correct view rather than today's true and fair view. And auditors conducted final audit as the main audit, which means there was nothing like continuous audit, interim audit, or what have you. All areas were given equal attention, meaning there was no high-risk areas or low-risk areas, and the auditor could do both auditing and accounting, as well as other services in one single audit. Auditor's independence was not a requirement, and again, the liability of an auditor was only limited to the contract.